but we need to talk. First, I'm gonna kind of add in a new series for um, educational speak or edu-speak. In the case of me observing what we're looking at right now, but also going slow enough to actually make sense of these charts. So, uh, consider this the process. We're going to be talking slow, but the information is going to be very important because we are currently 2023, October 23rd, Monday. Some referring to the fact that the trending keyword for today is Black Monday. Now, we have to remember Black Monday is not a good day. It's not like Black Friday. Black Monday was a 1987 event. It was pretty bad. There was very similar situations happening in the bond market, and we are actually going to be focusing more on that bond market while observing our fall from grace on our S&P. So first and foremost, I'm going to start off by saying each one of these charts has different values of observation, the values of these bars. For instance, you'll notice up here, you'll see those values highlighted as I move around. 1 hour for the QQQ, which is the NASDAQ mini, RSP, which is our S&P equal weight, QQQE, which is also an equal weight. Now, there's a reason I like to look at the equal weights to remove bias from large corporations, because in an actual ETF, the actual SPY or the QQQ, you're going to have a percentage difference between the strengths of certain companies. So the more strong a company is in the QQQ's aspects, tech stuff, the more valuation or weight that stock will have inside of this basket of goodies, which we can consider an ETF, a basket of stock goodies. Now, if we have a very good company in the tech market, they will basically put a lot more percentage value towards that company as far as a long-term growth company, and that would kind of skew our perspective because in that case we have an imbalance of proportions. This is why I like my QQQE on the basis of proportions. Now, as far as anything, all of the equal weights have been more than unsatisfactory, basically leading the way in the path. In one form, we got to remember big money, billions of dollar institutions, they can focus on one company very easily. Let it be Tesla, let it be Microsoft, let it be Apple. But in order to quote unquote manipulate the market to look good, you can't ignore the rest of the market, aka the smaller companies, the ones that are in the equal weight. So, in the case of comparing apples to apples, let's take a look at 5-minute equal weight versus the 5-minute SPY. You'll notice a much stronger decline in respect to our SPY equivalent. In fact, these yellow lines are two forms of bullish and bearish values, meaning a center point, an average, which is based on this little wave here called the volume profile, which we'll take a look into another time. But in relation, it's good to remember that this is how many shares are being traded and which end of the spectrum is winning in the case of oversold red or overbought green. Now, the case is that you have a lot of red here, there's a chance for a lot of green to pop back in the FOMO way where they're fearing of missing out. But in the live format of our current location, we're oversold before the market even wakes up. So one big concept here is just that the stock markets are not doing good. We've been expecting something, a lot of bears talking. We cut off that last support not too long ago. Right down here, you can see these bottoms of the previous movements. We can consider that to be a sufficient support. However, we've broken down, even tried to fight around it. We've broken below it, even going further and not waking up on a good round. So consider that as a starting theme. Market, no do good. Why? So let's talk bonds. In the case of bonds, we have to remember a couple of things. One, bonds are the baseline. And I'm just looking at this for the first thing in the morning, and we're at 514 10-year bonds. That's the fear. That's exactly why I'm streaming. So let me tell you what's going on here. Bonds are basically the rates in which money is lent, all controlled by the government. In the case of the Federal Reserve, which one would argue is the government, another would argue is not the government. Regardless, they control it. They have the valve. They can turn it to the left, turn it to the right, increase the pressure, decrease the pressure. Now, let me give you a better bird's eye, if not Hawkeye's view, of the last, call it 20, 30 years. I want to exaggerate the fact that we are very much in deep shit. Here's why. Let's ignore 1989. There was some issues there, but you can notice that when we reach this one value, now the red line right here is in one equal value. These are proportions, in fact, of division. There's your division in the middle of the US 2-year and the US 10-year. This is a very, very, very observed combination. One case scenario, one can argue that if you're putting your money in for a long period of time, you're going to bear more money. Because in the case of you locking your money into some bond, which government, state, or anyone else can use within the bounds of the 10 years before they return it to you. You're locked in for 10 years, you better get a better value. Now, the other case is 2 years. For less time you lock your money, less money you make. That's the logical perspective. Now, this is why I have this red line right here. This is the 1-1 reversal, meaning that, and you can look at the percentages by themselves, you can gain more money in 2 years locking your money up in 2 years versus locking your money up in 10. Yes, it is a very small percentage value, but that's kind of the point. As soon as these two valuations are essentially reversed, meaning I can make more money in the short term than in the 10-year long term, you have to consider the meaning of debt. Debt is used to build. If you don't have the money to grow, you get money, you borrow it, someone lends it to you, you build quick or long, doesn't matter, as long as you can return that debt over time. Now, the value of that debt is going to change by the risk. For the case of a long-term risk, 10 years, you have to be sure that nothing bad will happen in 10 years. Hint, hint. That's a long time to consider no black swans, or maybe after our crazy bullish run in the stock market for the last 10 years, we kind of are running at the end of our line here. 2 years is less of a risk. You lock it up for 2 years, do get your money. Whoever basically lends you the money does their thing, or a reverse process. You do your thing with that money, or they do their thing with your money. Case of them selling you a piece of paper treasury for money. Case scenario is 2 years is less of a risk, so it should bear less of a value. That's where the tables have turned. On the other retrospect, this 5% value has been broken, which is very, very, very bad. Now, here's why we like our reverse or 10-2 reversal. Let me go back a little further, open it up into the months. So now we're changing our perspective to month values, meaning each bar is worth 1 month time. Let's observe this situation here. If you look at the date at the bottom, that's basically 2000. That's where we had our 2000 crash. Here's the rule of thumb for this 10-2 reversal. When we breach up above 1, we are getting ready for a recession. When we breach back down, the recession will begin somewhere within that timeline. Not above. The recession will not begin up here. The recession will begin back down into the next downward turn. This has happened multiple times. This is, of course, the 2000 crash. It will happen somewhere around that cross section, either here or here, a month below, a month before, somewhere around this area. But as soon as we get close, there is a recession at hand. 2008, we kind of played around this section here for a while. And remember, when we're up here, people are saying short term bears more money. Meaning, I'm going to make as much money I can in the short term because I don't trust in the long term risk. Meaning, I don't trust my money safe for 10 years versus 2 years. That's a sign, or a red flag, if you will. That's a red flag for the case of long term investments. That is why stock markets essentially crash, because of the long to short term risks that flip. So in one way or another, you can look at this curve as the long-term and short-term risks and which one's more beneficial. Bottom side, you have long-term benefit. Top side, short-term benefit. But each time we breach above this 1-1 line for the reversal, we basically state that short-term is more appealing because something bad's going to happen. So there's 2019, a small crash that happened there. Then we had an interesting one, COVID time. If you notice, COVID did breach above and then fell back down pretty quickly. But the problem is we didn't stay below. This is a very unique situation because in all retrospects, we were either fighting with that upper band or eventually losing and falling below it. For here, we fought in 2022. A lot of money got printed, a lot of issues, inflation happened after, but this would have basically signaled the recession and we're done. Almost like a fake out. But if we just went back down, we however didn't. Not only did we have the 22 recession, we continued to increase the risks of the next recession. This is the highest we've ever been. If you do look at the history here, this is the highest this chart has gone. Now, the repercussions of this, of a magnitude, are unknown. If 2006 was here, and our difference now is about a 23% difference above, we may have at least 4 times the pain from 2008. One can consider this space above, again, a short-term benefit, more money for the short term. You've heard of money market funds possibly opening up 6-month, 3-month interests of 5, 6, 7%. That's odd. Why would everyone go into short-term investments and not in the long-term investments? Because of fear, because of predictive fear and the fact that we're not done yet. So we may have had a small little crash here in 2022 and we got saved, but that didn't actually end. And we can conclude this section right here has finished. So let me get a pen or something. Can I get a circle? Let's get a pen. This section right here, we've already had that recession. That was 2022 COVID. So they're not wrong on the news when they mention that, you know, the recession's over. It is over, but that one recession's over. We are now fully tucked above the 1-1 reversal or the 10-2 reversal. What that means, predictively, that we may see a recession very soon, within potentially even a big one within the next month, 2 months, maybe if we follow these lines with the typical bounce off that we would get, maybe it'll bounce off the 1-1 as a support, go back up, and maybe 2024 is going to harbor our recession. But the 2 case scenarios are happening within the next couple, or being decided on the next couple of weeks. Either we break through right now and we get the recession over with, or potentially lowering rates and more printing will essentially boost us back up for another bump before we break down below. So we may have a recession within the next few months, or we can postpone it to 2024. That's essentially what the bonds are telling us. This is bad. This is bad because either way we are going to get hurt. However, if we bounce, there's a couple of things I can recommend. Consider, at least for the short term, some tickers. Let me find where I keep these. I'm just gonna go, let's see over here. So the first one is TBT. If interest rates do continue to go up because of inflation fears, TBT is a potential place to go into. TBT basically carries over as a basket, not a tech commodities or a company basket, rather more of a bond treasury basket. So you can still invest in bonds by not directly investing in bonds. This is called the stock market. There are tools for these kind of things. The other one I recommend, UVXY. Be prepared for this one. It's already bouncing very heavy, and it's essentially the inverse of the SPY, which we looked at in the beginning. When the SPY goes down, it goes up. Yes, you can buy this for $20 right now. It is a short-term strategy. Do not hold these because they naturally decay in price over time. The best time to buy a UVXY, if theoretically possible, would be right before the crash, right before we go straight down with high velocity, or in this case, the SPY goes straight down with high velocity, meaning no green bars, just straight red. That would be the best time to take in UVXY. So UVXY, counter your stock market, hedge yourself from the collapse, and then TBT treasuries, and there's a couple of other options I'll talk about in the future, but as a starting point, interest rates go up, TBT go up, all right? Stock market go down, UVXY go up. So there are ways you can counter these actions and actually benefit from a downturn. Don't forget that. If you're an active trader, that should be something you know by heart. Knowing your tools at the time necessary. If we're going down, there's tools for that. If we're going up, there's tools for that. Fine. So that's essentially all I wanted to conduct here. We're not having a good time. The SPY is still inching pre-market downwards and downwards. We're going to break down below the 420 in pre-market, which is suspicious on my own observation. But 420 was a very solid support. It's, I guess, no coincidence we're breaking it in the pre-market when the rest of the world is sleeping. Now, we basically have an option. We have a couple of paths we can take. There is a downward pennant, path, whatever the case is. But we have these lower lows being connected and the higher highs being connected. This path can lead us to basically bounce around these areas. Notice how so far it's been bouncing off very well. These are no coincidences. Consider there are a lot of algorithms in the market. They follow these to their technical heart's desire. Keep in mind these indicators when we do technical analysis. Whether you believe in them or not, the algorithms don't care. They're going to follow them. And the more algorithms there are, the more basically flush these patterns become. And since the market is now basically algorithms, equations, and AI, well, where do we learn our information from? Fundamental analysis, technical analysis, and just the general macroeconomic status, sentiment. Those are the three sides of the triangle that basically make up the direction. So right now, we barely even touched to try and break that downward trend. We did try to break this trend twice, but you'll notice when we zoom in, it was only a brief moment before we dropped back down. This time even weaker than the last. These little pops that happen are very suspicious to me. They almost seem like they're trying to deceive people into thinking that we're going in the bullish while then being immediately dropped out. So some of these situations, these boxes can definitely start to seem a little bit suspicious when it comes to the fact of what you expect to see on a healthy market and what you're actually seeing in a unhealthy market. And yeah, so we've got a trend down. 2024 starts right here. So we can put a little marker here for that. Start of a new year. But we have time before we get there, and we're not doing so good. Considering, sure, it's red in the market. Great. That's a big deal. But it's not even the market that we're focusing on. Again, it's the 10-2 reversal. We either have a chance to break through right away, forcing the market to flush all margin out of itself, or we can bounce on the 10-1 value reversal line as a support, where these arrows are essentially guiding us. We could do a quick bounce, potential fight around these support lines, and then eventually break down below and kind of have a what do we call it? A digressed recession. It's being postponed for later, let's say. But these are the things that can happen because those in the money or those in the market have a lot of money. And letting something fall for a while, they can still maintain whatever upper levels that they cashed out, and then they can come in stronger down below. So they can make it bounce. But with that bounce, people are going to sell off because of the fear happening. So someone's going to lose money trying to make this market look good. However, if they do give up right away, then we're going to see this line break below, which will basically trigger everything else to possibly break downwards. And we have 380 as good support. We have the previous larger trend line. That's good support, but depends on where we break down or hit it. We might be able to catch it somewhere around 330 next year or 370 this year. But if we even go further and break straight through all these and come back into this negative downtrend, we'll basically be re-entered back to the 2022 recession trend down. Which in my case, theoretically, would mean that that was a postponed recession. That whole section, this whole little bit here of recovery, even some of these, wasn't real. They just sold at the top, bought at the bottom, and then everyone else got all happy about the next steps of the next upper movement. I'm gonna break that 480, go to 500, go to the moon, but we didn't even match up to the previous 477 high. We made it to 458, 460. That in itself, a lower high, is enough to tell you something's not right. Especially now that we're going in free fall after we've reached that second high or that second lower high. So if we do re-enter this previous trend of 2022, then essentially we're going down to 250. This is SPY, of course. We're thinking 25,000 in the actual SPX. We have that potential. Will we actually reach there? Probably not. But considering the past, this has a lot of strength. So we have a couple of situations, a couple of places we can bounce. I wouldn't say this one's that strong. I'm going to reduce the intensity of that opacity. So this one here, not so strong because we've only tested it a couple of times. But here, we've tested it multiple times, even during a recession back in 2020 or 2018, 2019 time frame. Of course, can things get worse? I've always concluded a theoretical process that potentially our natural flowing market is a sine wave with a higher to high situation. And once we kind of broke out of that natural movement, we've been on the upper end for a while. So we might even redirect ourselves back to where we were in 2008, where the SPX was 15,000, SPY 155. We might have a tap there because in relation technicals, you don't let go of a resistance until you tap back on. You have to show support. You have to show that if we go above this blue space, we have to come back down and effectively touch it a couple of times to show that we're ready to go again. But there's a problem here. We haven't touched it. We maybe came close to it a little bit after the pop up back in 2013, but no solid tap on the 153 support. And this is a very big support. This is where 2000 crash happened. This is where 2008 crash happened. So we want to show that we can support that value, that we are done with 150, that we have gathered liquidity all up from this space. But you know what else happened around the 2008? The reason why we went up like this in such a straight line? I know you know. Everyone knows. The banks got money. The banks got bailed out. Their purpose is to lend money to people. They didn't do that. Maybe 10% of what they got was lending money to people. The other 90%, where'd it go? They bought their own stocks back. This is why it went up. They didn't do the right thing. They should have opened up their pockets for lending to people. They did a little bit. It helped the market kind of recover, but they did the minimum necessary to break out from that recession. And then the rest of the money, they just bought their own stocks back. So one can say, ever since 2013 and us breaking out of that normal formula down here, the normal sine wave up and down motions, we're kind of, well, we haven't touched to support the fact that we're done with 2008. I would have been more confident that, again, we went back down, especially in this form here. This would have been a perfect tap down and then back up. That would have been even better to consider, even if we did it twice and then back up, right? Call them small recessions or not, but this tap on the support side from the top shows strength. It means we're done with that blue space. We're never coming here again. But what's the opposite? We don't know how it's going to act if we get down there. We haven't had support before. So in retrospect, I'm kind of massively worried about a $155 SPY or 15,000 SPX, but that doesn't mean we have to go back down there, considering that the money that circulates basically is 90% in the pockets of the big guys. And they can move that money back and forth pretty effectively, especially coming down from such a high value. So I can maybe see minimum, high probability, minimum location around 250, 25,000 for SPX. And the best case scenario, I can see 330, where we tap this upper space and we say, all right, we're done with the bottom below. We like being up here. We've been spending the money. Everyone's buying on this value space. It'll probably be some sort of rectangular area of high volatility and high volume between these two. We're going to be stuck in here for a little bit, gathering liquidity, people buying and buying more because it's cheaper in comparison to where it was at 450. Now it's 270, 280, much cheaper. Confidence goes up, morale goes up. So we may have a high chance of bouncing back from this location. But honestly, where we are currently, it does not look right. In one way or another, we didn't spend enough time in this downward turn. We should have came down here to tap this. The natural form, once you learn the natural flow of the stock market, it becomes much more and more visible. When we're going up between these values, we want to play around and then have some sort of confirmation that we're done down there. And then we can think about going up higher and go to the moon. We need that confirmation. especially from such high movements. We saw the previous confirmation that we missed way back down there in 2013. Now we're missing this confirmation. I doubt that can happen so many times before liquidity becomes very hard to manage in the $1 billion funding. At this point, we're playing with those $1 billion going in and out of the stock market. If you are a giant hedge fund, they can manipulate it much less to the highs with less power, less vigor, than they can manipulate it down below when it's cheaper. Because if they left at the proper time above, they can buy double, triple, quadruple the amount of stocks down here. It's less money, therefore easier to manipulate, especially if you've been invested in these ETFs over the long period of time and you've made yourself 300% income. Now going down, not only is it 300% income, it's doubled because it's half the price. Now it's 600% power value, and then they can buy up 6 times the amount. So that's why it's really difficult to say that we're going to go back to 150s, for that fact that we're so overinflated right now that there's going to be a midpoint. There's going to be a point in which we're going to actually catch ourselves, unless we go to a German-style recession. Then we can potentially see us going back down here. But in the case of us getting down here, our money will get inflated, and then we're just going to have infinite barrels of money. And that's not even going to make any difference. So be prepared. We haven't confirmed any technicals for a long time, any supports for a long time. We've confirmed this one, sure, but that's why it's so strong. But my worry is we haven't confirmed this one, which it's not too far away if we think of this value, 180 to 150. It's not that bad of a difference. So I don't see this happening. But at the least, we're going to go back down to our previous supports. And that's kind of the thing that potentially as a manipulator you're looking to do. You're trying to create these steps so that you can use them later, right? You're going to try and buy it up here. You're going to buy it up here, and you're going to buy it up here. Boom, you make it look like a reverse head and shoulders for a little bit of a boost. And then what? You sell up here. You buy, add, and add. For the cheap, you sell on the high. And then now that you're basically, 30-40% income from that, now you can focus on trying to confirm this so that your previous confirmation now is better. So we could see something like this. That would be also okay. That potentially would mean that we're not really done with the recession. And potentially more money was released into the market, and buybacks are happening again because stimulus packages for banks doesn't work because they don't use the money properly. Stimulus packages for the people doesn't work because they don't use the money properly either. But the case of self-development, some do, and they have used that money to increase their skills, while others go to Taylor Swift concerts, right? Now, the case scenario is that's very low. If we do end up doing this path, that would mean that the money was turned back on, the money printer. Inflation will be postponed and continue to rise for the next 10 years. And we're probably amplifying for a much bigger crash in the future. And you're going to hear YouTubers constantly complain about crashes and crashes and crashes and crashes, as they have been for many, many years. But that's because there's a form of manipulation happening. What they've detected in the data, in the models, is a true crash that's basically it's a hot potato being passed around. And then once in a while, Fed comes in, puts some water on the hot potato, makes it cool again, and then they keep throwing it around, but it's still getting hotter again, faster this time. Okay? It's something that's going to happen eventually. The problem is we don't know when. But on the overall perspective of things, making money on the way down is possible. I've got 200 personal shares of UVXY from 17. And now I'm hovering at 2017. About a 20% increase. So there's ways you can make money. Is it active? Kinda. Especially if you're playing with UVXY, you have to be an active trader. You don't want to leave this in for a month. You want to try and catch it on the volatility. Again, otherwise you're going to be end up stuck with this. The UVXY, again, naturally decays to 0. You don't want to hold this. You want to activate it at the time necessary to save your ass. And then get out when everything's better. Or the rumor of everything getting better. Buy the rumor, sell the news, right? But you're going to buy it before the crash, and then the rumor of everything is good. Then you're going to sell the UVXY, because the reverse logic here. You make money on the way down. So that's it. The market's crazy. War isn't helping. Bonds are going crazy as well. We just saw that. I mean, I'm surprised to see we're hovering above 5% now. We've broken the 5%, which we've never done before. I mean, not never, sorry. We have, but with the values of differences. You have to consider back in 2008, house prices were less than today. We can even consider, oh, we've been up to 15% before. Yeah, but go buy a house in 1981. It was like $50,000. That same house at 15%, it's not bad. But you take $50,000 and you make it $400,000, 4 times the price or 8 times the price, and only 1/3 of the percent, you're actually paying a lot more still for that house. So while we've never reached it before, the combination of high prices with this 5% breakout is what's going to cause some problems. And not only that, if this goes up, the ratio goes down. Notice where the US 10 sits. It's in the denominator of the fraction. The bigger the denominator, the smaller the digit. So if that 10-year goes up, we're breaking down. Okay, so that's it. I just wanted to do a quick emergency broadcast. It's been crazy out here. My life's been crazy. I'm going to start streaming again, more details, more technicals, more programming, and probably doing some stocks here and there, because I do find it fun to analyze the psychology of people buying and selling and the fear or greed events that happen. Which, if you look at charts, you really do get to decrypt human emotion in numerical value. So that's actually the very interesting part that I really do like. You can hear so many positive things in the news, but if you want to really know the actual situation, look at some numbers. Follow the money, not the mouths. So I'll be going into some stocks here and there eventually, but I do want to focus back on programming, which I will. I'm setting up a studio right now, and I need to play with some green screen effects to make it a bit more interesting, because it's programming. You know, some don't have that incentive to be motivated by programming, but it can be fun if the environment is fun. So that's it. All right, that's it. I'm out. Enjoy the rest of your day. Be careful out there, and if all else fails, just buy gold. If everything I just said was retarded and you have no idea what's going on, just have some gold, and you'll be fine. You'll be okay. Not fine. You may still struggle, because if we go down, we go down, but at least the gold is going to give you a head start in the new market. All right, well,